Economist Corporate Network in partnership with Raffles Quay Asset Management. Now, the title of our event today is From Capitalism to Creditism, Why Quantitative Easing Won't End Anytime Soon. As we all know, the Federal Reserve in America has been printing huge quantities of money and thrusting it out into the economy, massive monetary stimulus to keep the global economy going through this period of weakness. And if you look at 2014, the consensus view is that the global economy is returning to health, and that the American economy is returning to health. And so certainly most economists and most commentators, when they look at the situation, think, well, now is the moment when the Federal Reserve is going to start tapering, scaling back this massive degree of money printing that we've seen over the last few years. The global economy, the US economy in particular, doesn't need so much stimulus, so we're going to scale it back. And certainly that process has already started. However, our guest speaker today has a different view. He does not think that quantitative easing is going to end. In fact, his firm belief is that the global economy has become completely addicted to debt, and that if we push on in this direction of trying to scale back quantitative easing, we're going to tumble back into not just recession, but possibly even deep depression. So it's a contrarian view, and I'm delighted to welcome Richard Duncan to be our guest speaker this evening to help share some of his thoughts around this outlook, this alternative view of where the economy might be going.
Now, up until 1968, there was a law that the Federal Reserve had to maintain at least 25% gold backing for every dollar that it issued. And that wasn't a problem after World War II for a long time, because at the end of the war, the United States had most of the world's gold. But in 1968, they actually hit that point where they didn't have enough gold left to allow them to issue any more paper money. And so they simply changed the law and removed that requirement. And afterwards, there was no more gold backing whatsoever. And this allowed the Fed to issue roughly 25 times as many paper dollars as had existed up until that point. But the real significance of this break between money and gold was that it removed all the constraints on how much credit could be created. And afterwards, credit absolutely exploded. Total credit went from $1 trillion to $50 trillion in 43 years. This explosion of credit, it created our world. It made us all much more materially prosperous than we would have been otherwise. It ushered in the age of globalization. It is why Asia has been transformed by following a strategy of export-led growth, exporting to the United States, with the United States paying with credit denominated in fiat money. So it's easy to understand how credit growth drives economic growth. As long as the credit is growing very rapidly, everyone has more money to spend, the consumers spend more, so businesses are more profitable. They hire more workers, they expand their capacity, they build fancy corporate headquarters, and they even pay more taxes. So the government has more money to spend. And all the while, asset prices keep inflating, creating yet more collateral for the consumers to borrow against. But unfortunately, the day always comes, or at least it has always come in the past, when the credit can't expand any further. And at that point, the depression begins and everything spirals into reverse. And that's what would have happened in 2008 had the governments not jumped in with such extraordinarily aggressive fiscal and monetary stimulus. I call all of this creditism. Capitalism worked in a different way than our economic system. Under capitalism, say in the 19th century, the way capitalism created economic growth is like this. Businessmen would invest, some of them would make a profit, they would save that profit, or in other words, accumulate capital, hence capitalism, and repeat. Invest, save, invest, save, invest, save. That was slow and difficult, but that's how capitalism created growth. Well, our system doesn't work like that. Our system instead is driven by credit creation and consumption, and more credit creation and more consumption. And that's created very, very rapid economic growth, more rapid than capitalism would have done. The danger is that it's now going to break down, and creditism is in danger of collapsing into a new Great Depression. This chart, there are two bars. It goes back to 1952. In one bar, the red bar is the GDP growth, and the blue bar is credit growth, year-on-year credit growth adjusted for inflation to make it all equal. Now the thing to notice here is that there have only been 9 years when credit grew by less than 2%. And every time credit grew by less than 2%, there was a recession. And the recession didn't end until there was another very big surge of credit growth again. So of course this begs the question, what about now? Are we going to have more credit growth or are we not going to have more credit growth? Because at least judging by history, if we don't have more credit growth, we're not going to have economic growth. Credit has now grown to $58 trillion. So if it's going to grow by 2% after inflation, if we assume that credit inflation is going to be 2%, that means we need credit to grow by 4% to hit that recession threshold. Well, on a base of 58 trillion, that means that in 2014, credit's going to have to grow by 2.3 trillion. Well, in the most recent quarter, on a year-on-year basis, is only up 1.9. So we're not at that recession threshold. In other words, we would be in recession, in my opinion, were it not for quantitative easing. But luckily, as they say, fiat money makes the world go around. And that's what's making our world go around now. This shows the Fed's balance sheet. The Fed has printed more than $3 trillion since the crisis started. They have something like $4.2 trillion of assets now. And every time they print money and buy financial assets, not surprisingly, the stock market goes up. So in the crisis, the stock market was in free fall. This is the S&P. Then QE1 started and the stock market went up. Then QE1 stopped and the stock market went down and the economy had a soft patch. Then QE2 started and the stock market went up. And then QE2 stopped and the stock market went down and the economy hit a soft patch. And then they started hinting about QE3 at the end of 2012 and the stock market went up 30% last year. And home prices went up 13%. So what happens when QE3 ends? Much the same, I suspect, as what happened when QE1 and QE2 ended. But you can see that interest rates fell as the government printed money and bought bonds. This pushed up the bond prices, and it pushed down the mortgage rates and the yields on government bonds. So the bond yields went to very low levels, and that caused the property market to recover. This is the year-on-year increase in property prices. Property market's now up 13% year-on-year in the US. And the higher stock prices and the higher property prices have resulted in a surge in net worth, in other words, wealth. This shows household sector net worth. At the end of the third quarter, the most recent data, it was $77 trillion. This was up $21 trillion from the bottom of the crisis, and it's 12% higher than it was at the peak, pre-crisis peak. So by pushing up the asset prices, that gives the Americans more money to spend, despite the fact that their income is going down, median income. And therefore, they spend more. Consumption makes up 70% of the US economy. And that's been driving the economy. And that's been pulling in more imports into the US than would have occurred otherwise, allowing the rest of the world and Asia to export more to the US than would have been possible otherwise. The problem is last year, where do people normally get their money to consume with? It comes from income. And there's the most widely watched measure of that is called the real disposable income. Well, real disposable income, in other words, after inflation, it only rose 0.7% last year in the US, despite all of the stimulus. So if the income doesn't go up, then consumption cannot go up in a sustainable way. And income in the US is not going up, in large part, to a considerable extent at least, because globalization is driving down wages, and plus the aftermath of this imploding bubble. So now how long can this go on? Well, the good news is I think it can go on for quite some time, but it can't go on forever. Asset prices can only inflate so far relative to income before they become unaffordable. The income of the public is simply not high enough to allow the public to service the interest on the debt that they've had to borrow to buy the inflated assets. So there's a limit as to how high the asset prices can go, and the limit is set by the income of the public. And the median income is dropping. It's now back to where it was in 1989. you can think about the global economy. I like to think of it as a big rubber raft. But this raft, instead of being inflated with air, it's been inflated with credit. Now the problem is the raft is now fundamentally defective. It's full of holes, and the credit keeps leaking out all the sides. On top of the raft, you have all the asset classes: stocks, bonds, commodities, property. When the raft's sinking, all of these asset classes move down together. This is not the way it used to work. And furthermore, you have 7 billion people, all the world's population. When the raft starts to go down, these people start to get their feet wet. And if the raft sinks, it's not going to just be a matter of the assets becoming less valuable. People are going to begin to die, as they did in the 1930s and 40s. So there's only one possible policy response to this at this stage, and that's to pump in more credit. And when the Fed pumps in more credit, or the Bank of Japan, or the ECB, or the Bank of England, or all in unison, this reflates the raft. And all of the asset classes move up again together. Stocks go up, bonds go up, commodities go up, property goes up. And people, they're happy again, and everything looks good again. And that's where we are at the moment. So this is what the Fed's taper schedule. Last year they created $1 trillion, 85 billion a month. And what they've told us is that they are going to reduce this by $10 billion after every FOMC meeting this year. They meet every 6 weeks. So that means that in the first quarter they'll create 205 billion new dollars. The second quarter, 145, then 85 and 20, stopping, I believe, in October or November. And so at the moment, they're still creating a lot of liquidity. And that's why the stock market is still so strong, despite Russia and the Ukraine. But things are going to start to change. Now, I have something that I call a liquidity gauge. I'll give you a simplified version of this. Liquidity is injected into the economy when the Fed prints money and buys assets. And liquidity is removed from the economy by the government's budget deficit. So last year, the Fed created $1 trillion, but the budget deficit was only $700 billion. So in other words, the Fed created more than enough money to finance the government's entire budget deficit, with $300 billion left over. And this extra $300 billion is the reason the stock market went up 30% and property prices went up. Now, we can look at this on a quarter-by-quarter basis this year, given what we know about the likely budget deficit and the Fed's taper schedule, which we just discussed. On the first quarter, there's still going to be a lot of excess liquidity. Even more in the second quarter, because the Fed, after all, is still printing $150 billion this quarter, but in April, the Americans pay taxes. So the government doesn't have to borrow any money during the second quarter. So there's going to be even more liquidity next quarter, which suggests the stock market could really boom or could really continue to appreciate significantly. But things change in the third quarter, because by then the Fed's only printing 85 and the government's borrowing again. And by the fourth quarter, the Fed's really not printing anything, but the government's borrowing a lot. And so we're going to have a liquidity shift. During 2013, there was record amounts of excess liquidity, resulting in higher asset prices. And that's continuing in the first half, but it changes very abruptly going into the third quarter. And at this stage, if the Fed sticks with its current taper schedule, then I think during the third quarter, we'll start to see interest rates go up, property prices coming down, stock market coming down, net worth coming down, consumption coming down, US imports contracting, global exports contracting, and we're back in a global recession. Is the Fed going to let that happen? I don't think so. They've worked too hard to drive the economy by pushing up asset prices. So sometime around this point, they're going to announce that they've thought very carefully about this and have decided that more quantitative easing is needed for longer. I believe that in this new age of fiat money, that credit growth drives economic growth, and liquidity determines the direction of asset prices. And the government attempts to control both liquidity and credit to make sure the economy doesn't implode. I do think that this can continue for quite a long time, given correct government policy. I mean, for instance, look at Japan. Japan has been in crisis for 24 years, and they've taken their government debt from 60% of GDP up to 250% of GDP. And despite that, the interest rates on the 10-year Japanese government bonds, 60 basis points. So the US government debt is only 100% of GDP. And the US economy, the size, is 17 trillion. That suggests that the US government could spend another $17 trillion, borrow and spend $17 trillion before it even hit 200% government debt to GDP. And that's assuming that there's no GDP growth. Whereas, of course, if they spent $17 trillion, would have a massive economic boom. So I think this can go on for quite a long time. But it's not, can't go on forever. And moreover, it's important to understand what is making it go on, and that is the government. This is not capitalism. This is not driven by market forces. It's driven by government policy. So it's crucial to anticipate the government policy. Well, what I advocate, I think this can go on easily for 5 more years and probably 10 more years. But at some point, 10 to 15 years out, it's probably going to end quite badly. Japan can't keep doing this forever. So what I write about in my most recent book, the advice that I suggest is this. Look, we are on government life support. We are being propped up in this manner. But so how about this? Instead of us just having the government waste all of the money that it borrows and spends on too much consumption and unnecessary wars, why don't we borrow and invest that money in transformative new industries and technologies? I'd like to see the government over the next 10 years invest $1 trillion in solar energy, and $1 trillion in genetic engineering, and $1 trillion in biotech, and $1 trillion in nanotech. That would completely restructure the US economy. It would induce a new technological revolution. It would pull us out of this debt dependence trap that we're on. It would lock in another American century. And beyond all that, it would create medical miracles and technological marvels that would improve the well-being of everyone on Earth. So creditism has grave threats inherent to it at this point, but there are also undreamt of opportunities if we just understand how this new economic system works and take the most advantage of it. The reason this is possible now, and it was always impossible in the past, is something totally separate is going on now for the first time, and that's globalization. Globalization is extremely deflationary because you don't have to pay someone $200 a day to build a car in Michigan. You can pay someone $10 a day in China to do that. So the cost of your next worker is going to be 90% less. This is extraordinarily deflationary. So the deflationary forces from globalization are completely offsetting the inflationary forces from the fiat money creation, creating what truly is a unique moment in history, making it possible for our governments to borrow and spend trillions of dollars sensibly, hopefully, and to finance it with fiat money creation without creating hyperinflation. This has never been possible before. It's not going to be possible forever, but there is a window of opportunity if we just took advantage of this. But sadly, they probably are not going to invest $1 trillion in all of those industries I advocated. So they probably are going to keep wasting the money, and therefore it probably is going to end badly, but probably not within the next 10 years. So meanwhile, eat, drink, and be merry, because we are on government life support, and they're going to make the asset prices keep going up, because that's how the economy works in this age of fiat money.
Quick question. In the already rather bleak picture that you're painting, how do you see the growth of virtual currencies such as the bitcoins that are really not backed by any standards or even hard assets for that matter playing into that scenario?
Well, I know it sounds rather bleak, but if you think about it, it's really not so bad. What I'm saying is the government's going to keep pushing up asset prices. So your portfolio is going to increase in value. We're not going to collapse. And if they actually learn how to manage this, things could all turn out not just okay, but really fantastic. But in terms of bitcoins, I just don't see any purpose or any need for bitcoins. You know, for a while, they were very useful, people thought, in terms of laundering money. But now the authorities are onto that, and they've shut that down. the founder of Silk Road, is now in jail. And so if you want paper money, you've got the currencies. If you want a real asset, you've got gold. Why do you need, what purpose does Bitcoin serve if it's not helpful in laundering money? There is no, why would you trust something like Bitcoin, which has been around for how many years? 3 years? Look what happened in the last couple of weeks. Somebody stole, what was it, 400 billion Bitcoins, whatever that is worth. And the whole thing, it's silly to me. So I don't see the purpose of Bitcoins or any reason for their future.